make sense. However, if you listen to Howard Lindzen and Jim Altucher talk the other day. Jim Altucher has a book out. I forgot what it's called. Investing in the Apocalypse. And the book, from my understanding, isn't about crisis investing so much, but more about kind of that. He brought up the idea that a couple months ago everyone was concerned about Greece and the pigs and how that was going to ruin the market and topple the entire financial system, and it's a house of cards and it needs to come in. And when prices start turning lower below certain moving averages and we break support, you have to get a little bit cautious. But we never even broke the 50-day moving average back there. Now we have the inability to close more than one day below a rising 20-day moving average with all this news. So the fact is, I see a lot of people throwing around the terminology that we're in a bubble and this doesn't make sense. It's going to end badly. And I would say that, if we're in a bubble, so what? Great. Manage risk within the bubble. The bubble's not going to pop by just gapping down to 120. We're going to turn sideways. We're going to get more cautious, and then we're going to see this pattern of higher highs and higher lows. First will be interrupted, and then we'll see the market turn sideways and then start to break lower, and the moving averages will start to turn lower. They are not turning lower. We are not breaking this beautiful pattern of higher highs and higher lows. I mean, this stuff is just textbook example of key levels of support being held, resistance holding as support, and the market moving higher. So next week we'll want to take a look, obviously, at the levels that were important this week as far as that pullback right to the 5-day moving average. The rising 5-day moving average once again shows why it's important to watch that on an intermediate term basis. But 131 and a quarter next week will be interesting. And of course it's a bubble, says someone, and who cares? So what? Great. But it doesn't have to end badly if you're managing risk. Recognize the fact that we're in a period where prices are appreciating, and you manage risk accordingly. Don't be chasing stuff that's already moved. You don't want to be the guy buying CMG way up here. You want to look for low risk areas to be buying big strong stocks when CMG and these other stocks begin to move. You want to anticipate, as I was talking about, Intel has the potential maybe to get moving. I mentioned that earlier in this week. Is we've got this longer term on the weekly time frame, what looks to be an inverted head and shoulders pattern setting up, and within that, so here we are in this right shoulder, but within that on the daily time frame, what we're seeing, and let's just back that up a little bit here, is that we've got this inverted head and shoulders pattern. It's yet to trigger a buy. Really needs to break probably above $22 a share. Above $22 a share, then we want to look at Intel and say, okay, that's where the higher high comes in. And then how can we manage risk? Well, if we buy above this 22 level, let's say, would your stop go below 21.35? To me, that seems like a lot of risk. 21.50, just 50 cents risk in a stock like Intel seems pretty wide as well. But when this thing goes, if it goes, it looks like it should make it up to about 23.5. So would you be willing to risk 50 cents to make maybe $1.50? And that just gets us up to the neckline of the weekly chart. So you have to take a look at it. And you can't just say, well, the height of the weekly pattern indicates a price target of basically, the height of this is 12 to, let's just call it 24. That indicates that the stock would go from 12 points higher up to $36 a share. That's really kind of aggressive. That's pushing the envelope. I think you want to look at, first realistic objective upside target could be 23.5. If the stock continues to behave well, then you raise your stops underneath the higher lows and you let the market tell you when to get out. Don't let the crisis in Egypt tell you when to get out of the S&P 500. If the market reacts, then you want to listen. But again, our analysis really needs to be pretty simple. Most of the time, the value of the news disappears very, very quickly. Warren Buffett, I think, I'll probably butcher his quote, but Warren Buffett, I think, says, in the short term, it's a voting machine, and in the long term, it's a weighing machine. It balances out. It gets all those emotions out. It balances in, finds out where's value, what's important, what's not. Short term, you're going to get the market jerked around by employment numbers, by oil inventories, by the next crisis overseas, wherever that may be, and people can panic about what can go wrong with the Suez Canal and all that sort of thing. But the fact is, we're in a bull market. This bull market is super strong. We're showing, a continued pattern of higher highs and higher lows. So let's just focus on staying with the trend. It's much lower risk and much lower stress in my mind to go with the trend than it is to try and fight it. So, early next week, what do we want to see hold as far as support goes? We want to see 132.50 hold. That was tested today. That was the highs from, Tuesday afternoon and Wednesday morning. So that resistance held as support intraday today. That's what technical analysis is supposed to do. The resistance broken tends to act as support. Well, it did here today. So 132.50 is important. We're going to have that rising 5-day moving average come up and meet that level as well. If that area breaks, then we want to get a little bit cautious and think that, well, the next area that this market should focus on is down near that 131 level, because that 131 level had been prior resistance. 131 down to this week's lows of about 131.25. This should be the next, bigger band that if this is broken, then you want to get a lot more defensive, because that's what price action tells us, not because that's what a crisis overseas tells us. Again, it's price that pays us, not who's in charge of some government overseas. Not to say that it's not important, but again, going back to that book that I was talking about, Jim Altucher was saying, Greece was going to take down the whole system. We haven't seen a headline about Greece, or at least I haven't, in months. It magically disappeared. The pigs was the big acronym that everyone was focused on. Whether there's, whether it's going to be SARS or bird flu or whatever, these things come and go, and they impact prices short term. But the longer term trend, it takes much more to reverse it. And if it's not correcting, at least time-wise, we're not even getting time corrections in here. This market is just marching straight forward. We get 2 weeks at the most of sideways activity. It doesn't mean, again, the main point here to take away isn't, hey, I'm a bull and I'm going to stay a bull. That's not the way I've ever been throughout my career. Throughout my career, I'm bullish when the market's going up and I'm bearish when it's going down. I'm not looking for reasons to buy. I'm not thinking that this is overdone and this is the bottom and it has to turn. Instead, it's a gradual process, and I begin to get bullish, and then the trend emerges, and then you have to embrace that trend. At no point along that trend line do you ever become fully complacent and let your guard down. Defense is the most important position in investing and trading. If you have a strong defense and if you can protect yourself, of course you're going to get hurt once in a while. There's just there's no doubt about it. But this market is providing us with today 2,200 advancing stocks, 789. I don't know how many of those declining stocks are actually inverse ETFs, but the point is continue to focus on what are the important levels. As long as we hold above those important levels, it's innocent till proven guilty. If it's uncomfortable, investing is not supposed to be comfortable. It's you're taking risk. Risk taking isn't naturally something that comes naturally to us. You have to choose to accept risk. You have to choose whether you're going to take the green slope down down or go down the double diamond. The people who go down the double diamond, hopefully are skilled enough to do that. It's similar to day trading. You should be skilled enough. You don't take a first-time skier down a double diamond run. You put them on the 100 shares or the green run so they can make it down safe, and they can come back tomorrow and try a blue, and in 2 weeks do a black, and then bring them to the terrain park and all that stuff. But the point is, there is risk in the market. It's unnatural to really embrace risk, so we have to manage the risk, not go all in and say, hey, the gamblers don't do well in the market. I'm not talking about the gamblers like the classic movie Rounders, where Matt Damon is trying to explain to his girlfriend. Do you think it's a coincidence it's the same guys at the final table every year? Are they really gamblers, or do they know something? Is it any coincidence that some of the top money managers end up on top year after year after year, whereas the average mutual fund continues to underperform? The average participant in Vegas loses money. They don't go there expecting to win. They don't treat it as a business. They're not managing risk. Our job is simple. It's to manage risk. The Nasdaq 100 continues to chug higher. Like I said, I think that we should probably be focusing more on the composite. And as the Nasdaq composite, is starting to close in pretty. Let's see. I don't know. It's an area that we can look at and focus on and say there is the potential level of resistance, or perhaps it's going to be similar to the level that this longer term level on the Nasdaq composite right here at 2861. Maybe that's going to be similar to the longer term level that we broke past from 2000 in the Nasdaq 100, and this Nasdaq 100, we're up against prior support back in here on this monthly time frame, so it has the potential to be resistance. But you got to be a fool to just run in there and sell this thing short and get beat up day after day after day here as this market just continues to move higher. What's the important level for next week for the Nasdaq 100 to hold? Well, it looks like probably 57 and a quarter. If we break below that, right before that, a bigger an important level is 57.50. So basically, this is our band of support that should hold next week. If we dip down, close that gap, whatever, fine, whatever. Maybe we need to correct a little bit through time, but breaking down back below that 57 level, 57 and a quarter, maybe it's time to be a little bit more cautious. It's always time to manage risk, but even before that, we're going to have this level that also similar to the S&P 500. The Wednesday and Thursday highs did become support in here today at 58 and a dime, let's call it. So we got 58 and a dime, then we got 57.50, 57 to 57.50. If those levels break, then we'll probably see the 50-day moving average. That wouldn't be a bad thing. That might be the pause that refreshes this market so it can continue even higher from here. Let's not try to impose these opinions and beliefs. The Russell 2000 has been a leader in this market, and this market did experience a correction through time. A lot of people were looking for the Russell 2000 to break down, but it had held this prior level of support, and it held above a rising 50-day moving average. It refreshed, it paused through time in here. So it had this little failed breakout. It shook some, came back in pretty quickly. It refreshed, and here we are at new highs on the Russell 2000 for the year, closing right at the top end of the range. And it's just persistence of trend. You talk about persistence of trend, look at the UNG. Here's a stock or excuse me, an ETF, which is a flawed product because of the contango, and I don't even understand it. I don't want to understand it. All I know is that this doesn't represent very well the price of natural gas, but it's in a clear downtrend on this weekly time frame, and every time it bounces people get excited, but we've still got that declining 10, 20, 30, 40 week moving average, and prior levels of support acting as resistance. And here we are in the UNG, very close again, and let's just take a look together. I don't even know that on a closing basis, it looks like this is the lowest that UNG has ever closed. So, on a closing basis, there's only about 2 days now. People who've been holding really below. There's only a day and a half of trading, basically, that if people bought and held the UNG, that they're actually making money. And it's a sad thing, because people keep falling for it over and over again, trying to pick the low. It's down too much, whatever. It's no different. Buying UNG is no different in my mind than selling short SPY. You got to be out of your mind to do it. Go with the trend. Be like water. Go, follow the path of least resistance. Anyways, the semiconductors have been the real leader in this market, and they are up at an important level that prior support tends to act as resistance. It didn't last, at this last stop. It did for a very short period of time, and we've been focused on these semiconductors and the health of the semiconductors, and how we broke this trend line, and that just indicated a correction through time. The market reinvigorated itself, higher highs and higher lows. Just a real strong pattern of higher highs and higher lows. No indication whatsoever of topping. I've heard every single reason I think there is why this market's overbought. Every political, fundamental, people send me the links, and I never read them. Sometimes I read the headlines, but I usually delete them and reply back. Only price pays is my standard line when people send me that, and what I'll refer to as nonsense, because it just distracts me from price action, and that's where I want to stay focused always. So anyways, the financials, same thing. We broke to a new high. This resistance at 1675 held as support. It just classic technical analysis 101, where we've got rising moving averages. We had a correction through time. We never broke that support. If we broke that support, we would have been defensive and thought maybe it would go down to test the 50-day moving average. It didn't do that. We give the benefit of the doubt to the buyers when the primary trend is higher, and here we are right now, very close to if in fact, I don't even know, what is this high? I have to keep doing this trick to get my pencil back, but this high here was 1709, or I'm sorry, that was the high that day, $17.12, and 1713. I'm sure there's people out there, I'm sure you'll see blog posts this weekend, or you'll see some kind of nonsense about a double top. That's not what a double top is right now. It's just, we've run into an area where where we have been before. We break through here, then we have continuation. We have higher highs and higher lows, and it looks more likely that we're headed towards 18.5 than it does to a correction back to 15. But before I wouldn't bet on that. I would say, well, as long as this market can hold up above that 1675, 1680 level, you give it the benefit of the doubt over the intermediate term. And shorter term, maybe $17 a share is where you put your stop. You have to define yourself in the time frame that you are looking at. And gold should be going up with all this internet. If watch that. Very inventory. Wednesday. Well, then you all